With fixed rates at ridiculously low levels, is now a good time to fix? Hi, my name is Max Phelps. I'm a money coach with Golden Eggs, where we're on a mission to help people stop worrying about money and get on the path to financial freedom. Now, this is a question that comes up all the time, and it usually comes in the form of, is now a good time to fix? Now, I don't want to get into that discussion too much, other than to explain that when you're fixing three things. The first thing you're fixing is the rate. Now, everyone focuses on the rate. Is it good? Is it bad? Will it go up in the future? Will it go down in the future? Honestly, none of us really knows. We don't have crystal balls. So instead, the focus is on, is it right for us at the time? And let's look at the other two things that you're fixing. The second thing is the term. So you might fix for, say, 3 years or 5 years. Now, if you want to get out of a fixed rate before that, the bank's going to sting you with break fees because you've basically promised to pay them for that period of time, and they want to make their money back. The third thing is the one that catches most people out, and that's the amount of money. So if you've got a $500,000 loan and you fix all of it, and then you suddenly realize that interest rates are really low and you can afford to pay extra, the bank's going to go, wait a minute, you promised to pay us the interest on $500,000 and now you want to give some of that money back, and that means we can't charge you interest anymore. No. So typically you can't have an offset with a fixed rate loan. There is a couple of lenders that do it, but most don't. And also you can't make extra repayments, or there's a limit to how much extra that you can go in. So in most cases, the guideline that we would go with is that you always want to have enough of a variable split, either with redraw or an offset account, that during that fixed rate period, with the best will in the world, with the most optimistic view of your income and the most and expenses, is how much extra can you pay off the loan, and make sure that much is variable. Then if you want to fix the rest, no problem at all. So generally speaking, the first loan, and typically the one that you're living in, is where you want the variable portion, and then you might have a bit fixed, and then after that, as you build a portfolio, then maybe the second property, maybe the third property, maybe the fourth property are fixed. But again, from a risk management point of view, which is what we really used fixed rates for, is you don't want to fix all of your loans at the same time to all be coming off at the same time. Otherwise, you could be in a situation of being hit with higher rates at the end of the fixed and not being in a position where you can refinance or renegotiate the rate. So if you do have a larger portfolio, we'd recommend, having some rate finishing next year, some the year after, some the year after that. And it also just hedges your bets on the risk. So that's it for fixed rates. My tip is always to use them as a risk management tool, and not about a rate's high or low, or is it the right rate, because then we're just guessing. If you've enjoyed the content, please like and share it with your friends. Otherwise, remember, it's important to always be genuine, have fun, stay curious.